I spent years wanting to invest, but never taking the first step because I was scared to lose money. I didn't know where to start, or I thought I needed to be rich or have more money to start investing. And baby, I was wrong, okay? You can actually invest with just $100 and get ownership into some of the top US companies like Apple, Microsoft, Tesla, Nvidia, who's behind all this AI stuff. Yeah, with just one purchase, one investment. Not 5, just 1. And it's called ETFs, exchange traded funds. And we're going to talk about them on this video today. And by investing just $100 in ETFs or index funds, I have been able to grow my investment portfolio to over $250,000 over these last 5 years. And I didn't have to cut back on the things that I love, like traveling and beautiful life experiences, okay? And I call this my lazy girl approach to investing. And if you are anything like me, a girl who likes the finer things in life, but also wants to have money to afford them, then this video is for you. So before we get into it, hey girl, hey, my name is Jocelyn, and I am a certified financial educator that teaches women how to invest in the stock market and grow their money with confidence while they continue to live their best lives now. Because for me, a soft life will never equal a broke life, okay? You can do both. So let's get into it. What is investing, okay? Investing is essentially putting your money into assets that will grow. These assets that I'm thinking of specifically are companies, These companies are publicly traded on the stock market, Think of the Apples, as I mentioned, the Google, the Netflix, the Meta, the Nvidias, any kind of public company you can think of. All these big corporations are likely on the stock market. And as you invest in them and as they make more money, essentially you make more money because that's the point of being a shareholder, okay? And this matters because if you do not put your money to work, if you don't start investing your money, and it doesn't have to be the stock market, if you don't put it into real estate, if you don't put it into something else that can keep up with the rate of inflation, which is the cost of our goods and services increasing year after year, you will be working forever for your money, baby. You're going to be working that job that you hate. You're going to be working till you 70, 80, 90, and that's not what I want for you, okay? I want you to be able to live your best life now and know that you got money for the future. And in order to do that, you have to start investing. The earlier you start investing, the better, y'all. And you don't need a lot of money, as I mentioned, just $100. And what I do with that $100 is I put it into ETFs. So what are ETFs? Because that sounds like mumbo jumbo, okay? ETFs are exchange traded funds. And essentially what I want you to think of these, because I believe in beginner friendly knowledge, is think of them as a bag of stocks that you buy. These stocks are essentially things that allow you to own companies. All companies publicly traded on the stock market have shares. They have stocks. And if you buy some of those stocks, that gives you ownership into said company. So as they make money, again, you make money, which is what we want. We want to be, as much as we consume these companies, we need to be owners of these companies. You can do both, okay? So what an ETF does, an exchange traded fund does, is it allows you to buy a variety of company stocks for one purchase price, y'all. And I love this because it helps you to do two things. It helps you to get started with less money, because sometimes if you want to buy a Google or an Apple outright, you may need $200. You may need $300. Now they have fractional options too, where you can, put a certain amount toward it. But with ETFs, it's a no-brainer. You can start again with just $100, and that gives you ownership into more than just an Apple, for example. It gives you ownership into multiple companies. I just mentioned a bunch of them: the Apples, the Microsofts, the Berkshire Hathaways, the Nvidias, and that is a real thing, y'all. It's called an ETF, and the ETF that I'm referencing is VOO. VOO is an S&P 500 ETF that essentially tracks the top 500 companies here in the US. I love VOO, okay? I love it. I have it in one of my accounts. And essentially, when these 500 companies are doing good, you're doing good. And they are required, they're not required, I'm sorry. Some of them will pay dividends. And dividends is essentially a small piece of the profit that they earn that you get as an owner, as a shareholder, okay? Now, again, all companies don't pay them, but all companies are going to be slated to do well. They want to make money and you want to make money. So that's why it's important for you to invest. They're never going to put themselves in a position where they can't make money. You see Apple always coming out with new stuff. You see Google always coming out with new stuff. You see Nvidia coming out with new stuff. So as they continue to innovate and make more, you will make more in the form of dividends as well as the growth of your stock. So if you buy a stock, VOO, for example, and you bought it for $200, and it grew to, $1,000 because of the success of those companies in that ETF, that's a good sign for you. Ultimately, we want our money to grow. So that is what an ETF is. And let me know if that makes sense. Comment below. I try to give real life examples and make it realistic. And on the other side of ETFs, is, index funds. So index funds operate pretty similar to an ETF. The main difference is that often it has a minimum required amount that you have to put toward an index fund. And the index fund that I'm thinking of is VTSAX. This tracks the total US stock market. So every single company that is on the public stock market here in the US, you have partial ownership into. Now with the VTSAX, for example, I believe you have to have a minimum account balance of $3,000. And I'm gonna tell y'all a little story a little later about VTSAX because that's where I started. But again, I don't believe in having to start at the top. $3,000 is a lot to ask somebody to give. That's where I started. Do I recommend that? No, okay? What I recommend, actually, before I get into that, so you're probably wondering, what is the difference between the two of those, the VOO versus the VTSAX? Again, VOO tracks the S&P 500, which is the top 500 companies here in the U.S. A lot of them are large cap companies, meaning they make $2 billion or more annually, versus VTSAX, which tracks all of the companies on the stock market, not just the top 500. So you may get a JetBlue on there, you may get a Etsy on there, you may get a Netflix on there, and both of them give you diversification, which is what we want in the name of the game. We want to have the low risk investments, okay? We want everything to be diversified. That way, if Apple tanks, but Google and Meta and Nvidia are doing well, I'm not going to feel no pain. Now imagine if I just put all my money into Apple and Apple acted a fool. I'd be going crazy, okay? So diversification is what you want to focus on, and index funds and ETFs give you diversification. Also, low risk, okay? We don't want to put our money into something like cryptocurrency and Bitcoin as a beginner. I don't even invest in those things. And the little bit of Bitcoin I do have, my financial advisor was managing, okay? I don't invest in that anymore. I mean, it's still there because I don't believe in selling because of capital gains, which means you got to pay taxes when you sell. We don't do that around here. We just leave it alone and we invest in the things that make us money. So again, going back to the difference between ETFs and index funds, essentially they operate in the same. They allow you to have visibility into multiple companies for one purchase price, but the difference is that index funds, again, sometimes require a minimum amount in your account in order to buy them. Also, they only are allowed to be bought one time at the end of said day, because essentially what you're going to be doing is buying something at the net asset value, which stands for NAV, and essentially that's the price you pay per share in there. So they don't allow you to buy it until that net asset value is set for the rest of the day. So usually the purchase goes through at the end of whenever the stock market closes, which is usually like 5 p.m. You know what's happening in New York, y'all, on Wall Street. As I mentioned, you also have the minimums that you have to have in your account. Sometimes it can be 1,000, it can be 3,000. For VTSAX, it has to be 3,000, Now, it may differ what kind of brokerage you use. Maybe if you use Vanguard, it's not 3,000. I don't have a Vanguard account. So you have to just kind of understand, where you should invest and what makes the most sense for you. I personally use Fidelity, and I love Fidelity for many reasons. We'll get into that on another video. Another key component of index funds is that you can automate your investment. So not only can you automate $300 to Vanguard, you can then tell Vanguard every single month, I want you to invest in VTSAX with that $300. You cannot do that with ETFs. It's something you have to go in and manually do, unfortunately. But I still think there's room for both. I have both in my portfolio, okay? Lastly is that index funds, from a tax perspective, are usually a little less tax efficient because of capital gains. Essentially, as I mentioned, you pay capital gains when you sell shares, when you sell your stocks, so they're not as user-friendly, tax-friendly to the person who owns the shares. and I need them to be, So it's like, that's why I say I don't sell too much of anything unless I know that it's tamed. Like if I lost a lot of money, and that hasn't been the case for a couple of years, because I know what I'm doing now, okay? So that's index funds. Now let's talk about ETFs, exchange traded funds, how those differ from index funds. And that is that they trade all day. The way that you could buy a stock, an Apple, a Google at 8 a.m., you could buy another one at 1 p.m., you could buy another one at 5 p.m. ETFs work the same. They trade similarly to a stock, There's often no minimums for these. You can start with $1. I don't recommend that, because how can a dollar grow it, baby? I always tell y'all, $100. Do not play with me. Do not put $1 into your Roth IRA. Do not play with me. Don't play with yourself, okay? But again, they allow fractional shares, because one thing that people see is like, okay, you told me to invest in VOO. I didn't tell you to do nothing, okay? I'm using examples here. I'm a financial educator, not an advisor. But VOO, for example, can cost, what was the last price of VOO? Let's just do a quick Google. VOO today is $617.35. Now you're like, you told me to put $100. Yes, because there is something called fractional ETFs, which means that you can buy a fraction of the ETF and still be an owner. Now, you're not a full owner of one share. In order to get dividends and things, you need to make sure that you own shares, not fractional shares. But it allows you to get in the market. And as I mentioned, we're investing that $100 consistently. So within 6 months, you will have reached $600, which means by month 7, you will have a full share, okay? And that's just $100 as an example. Eventually, you're going to see some wins, and you're going to have more money, and you're going to be able to invest more. But I love ETFs because they allow you to get started with less money more quickly. They do not allow you to automate, as I mentioned. So if you wanted to say, hey, Vanguard, invest in VOO for me, it's a little harder to do that, which is where index funds kind of win. It's very set it and forget it, allow it to work on your behalf. But I don't mind logging in and making a few purchases, okay? Sometimes that's beneficial to see. And then they also, from a tax perspective, they are more tax efficient because of their unique buying and selling process. It's not a part of like an index the way that, index funds like BTSAX are. So a little more better from a tax perspective for you to have. Let me know if that's clear. Let me know if you have any questions below. And please like, comment, share, subscribe to this video. So let's get into what y'all want to hear, which was, what was my approach? What is your lazy girl approach to investing, girl? Well, let's talk about first what I did wrong, okay? I had to make a lot of mistakes to get it right. The first thing I did wrong is that I invested in VTSAX. Now, I'm not going to say that VTSAX is not a good thing to have, but where you invest that VTSAX matters. As I mentioned, y'all, I do not go with Vanguard because Vanguard charges a little more fees than what I like. You have to pay fees to buy some of these investments, y'all, to buy most of them. And I wasn't liking what Vanguard was giving, okay? So what I did is I opened my Roth IRA at Fidelity. And Fidelity is not a Vanguard-based company. They have their own index funds. They have their own ETFs. And VTSAX stands for Vanguard Total Stock Market Index, okay? So Vanguard is like, oh, you want to buy VTSAX and you ain't buying it at our brokerage, at our Roth IRA? Bet, $3,000 minimum. It took me a while to invest and get to that $3,000 minimum when I could have just invested in the FZROX, which is Fidelity's comparable index fund. That's what I do now. I went about it completely wrong because I saw a bunch of videos telling me that I needed to do this and that VTX will give me visibility into all these companies, which it does. But what was missing is how you invest it and where you invest it, okay? I don't think if I had a Vanguard account, I would have to have the minimum 3,000 balance. But either way, I prefer Fidelity regardless, okay? And I'm going to talk about, comment below if you want me to give you some comparisons on these brokerage accounts and online brokerage accounts, because they are not all created equal. Both are great. I don't have no shade against Vanguard, but I'm a Fidelity girl through and through, okay? I love Fidelity. Fidelity ain't did me wrong, okay? So what would I do if I was starting over? I would put that $100 into an ETF. I would put it into VOO because VOO doesn't have a minimum required balance in my account that I will need to have. And it is essentially the ETF, exchange traded version of VTSAX, without the minimum balance required, y'all. I told y'all I needed $3,000 to invest in VTSAX because I wasn't a part of their Vanguard brokerage. My brokerage was Fidelity. So I should have been focused on Fidelity's account, or focused on ETFs like VOO, VGT, VTI. VGT tracks the top it tracks the top tech companies here in the US. VTI is tracking the top, I think I explained that wrong, y'all. Sorry, let me start over. VOO tracks the top 500 companies here in the US, okay? VTI tracks the top, or the total US stock market, all of the companies in there. It's the ETF version of VTSAX. So correction, sorry about that. I'll be confusing all these V's consistently. And then, did I cover all of them? VTI, I'm gonna put this on the screen. VTI tracks the top, all of the companies on the US stock market. VOO tracks the top 500 companies in the US, okay? These are large cap companies, 2 billion or above. Think of the Microsoft, Apples, things like that. VGT tracks the top tech companies here in the US. I had to get that clear because all these acronyms can get real confusing, which is why I have a workshop, okay? But yes, I'm a huge fan of just starting with what makes the most sense and allowing me to put the least amount in the beginning and still get the biggest bang for my buck. And so I would have just started with something simple like VOO, which is, again, the top 500 companies here in the US, or I would have did VTI, which is the total stock market, having ownership into all of the companies on the stock market here in the US. Those are both ETFs. Now, if I wanted to go the index fund route, and again, I use Fidelity, not Vanguard, I would have chosen zero expense feed index funds. And so essentially, in order to own any kind of shares, you have to pay a small amount of money. And it's not a lot, y'all, but it's called an expense ratio. It's the price you pay to own ETFs, index funds, things like that. And the goal is to keep it as minimal as possible. And Fidelity has some zero-based expense ratio index funds, and I invest in them. I invest in FZROX, which is, again, very comparable to VTSAX. It's literally just Fidelity's version, and I don't pay no expense ratio fees on that. And then they also have their own, top S&P 500 funds and stuff like that. I just don't do those because I already have VOO. It doesn't make sense to have Fidelity's version and Vanguard's version. I'm trying to minimize overlap, okay? So instead of that, I invest in REITs, real estate investment trust. I invest in international stocks. I invest in VGT, which is obviously tracking all the top tech companies. I invest in an energy ETF as well. It's called FSENX. It's tracking some of the top energy companies. So think, not Clorox, child. What's the name of that darn? Chevron, ExxonMobil, things like that. Sorry, I was going to say Clorox, child, but that is what I would do if I started over. I would buy the funds associated with the brokerage that I signed up for, and I would start with ETFs first before I moved into index funds, just so that I can get started with minimal amounts, and then I'd graduate up to index funds, because my index funds personally are outperforming my ETFs. But if I'm starting with $100, I'm not looking to jump into index funds. We do those later when we got a little more money. Okay? And that's what I'm going to be coaching my girls on a little later. Like, we'll have a whole group coaching program where they invest their first $500 instead of $100. And we don't want to put all of $500 into just one ETF, one index fund. So then I'll talk to them about diversification and stuff like that. So if none of this makes sense to you and you're like, okay, girl, $100, one ETF, one account, which is a Roth IRA, y'all, please do not start with Robinhood and all these other individual brokerage accounts, because they tax you like crazy, which means that if you buy something like VOO and it increases over time, you are taxed on that money. With the Roth IRA, with the traditional IRA, you're not taxed on your growth, okay? Which means that you don't pay no taxes on the growth of your account. And obviously our account's gonna be growing, baby, because we are buying right from the very beginning. We're investing in the right things from the very beginning. So we're going to see the growth, but we want to keep that growth for us, okay? Which is why the account you invest in matters, and what you invest in matters, and where you invest it matters. So if this sounds like something you want to prioritize, if you want to become an investor, HER in 2026, you had it on your vision board, on your dream board, and you scared to get started, then join me for Investor Live, which is my live workshop where I will walk you through in real time how to invest your first $100, y'all, in the stock market. I'm not investing it. I'm showing you how to do it. It's live. You'll get questions answered. I'll screen share. I'll share with you what's in my account and why I bought what I bought. I'll show you my mistakes too, baby. I'm showing you everything so that you start off right from the very beginning, y'all. And again, this is live. It's happening on Saturday, January 31st, because I want to get more girls winning. I want more girls investing, because if you don't invest your money, you're going to be working forever for your money, and that's not what I want for you, okay? So it'll be a small group of us. You'll meet like-minded women that are serious about investing. You'll be able to ask your questions. I'm going to explain it super beginner friendly, y'all. One account, which is going to be an IRA, whether it's a Roth IRA or traditional, $100, and we're investing that every single month for the rest of 2026. Don't play with me. If you can spend $100 on Eat Out, you can spend $100 in the stock market so you can grow your money. And then one ETF, okay? Or an index fund, depending on how much money you got going on. So again, we're going to talk about all of that. We're going to do it together, y'all, on Investor Live, which is where you're going to walk away with your first $100 invested, y'all. I'm so passionate about this. As I mentioned, I made a lot of mistakes. I did a lot of things wrong. I'm going to tell y'all the truth, okay? But despite all of that, once I found my lazy girl approach, I've been sticking with it, okay? And all of my portfolios combined are worth more than $250,000. And that's what I want for my girls, okay? I did all of that with a 9-to-5, okay? I did all of that with a 9-to-5. So if I can do it, I am special. But I'm no better than you, okay? So I want to get you started. I want you to be confidently investing. I want you to be educated on what you're buying, why it matters, so that you're not losing money, or if you do lose it, you understand why, and you're not rushing to sell, because again, we're avoiding taxes, period, okay? We already got to pay the IRS for working, for breathing. We don't want to pay them to grow our money too. So hopefully this was helpful. Please comment below. Every comment, y'all, every like, especially every comment though, allows this video to be seen by more people. It signals to YouTube that this is good content. So even if it's thank you for the video, if it's a genuine question, y'all, as you can see, I'm a genuine person. I will answer. I'm going to tell you the truths, and I'm going to tell you the mistakes, okay? So yes, please like, comment, share this video, subscribe to the channel if you haven't. I have so much more good investing content, some more baddie on a budget content, because you can live your best life and still have the money to do it, and still be investing and still be saving, because this is my lazy girl approach, okay? One ETF, one index fund, $100, one account, y'all. And then we're gonna grow that as you make more money, as you get your tax returns, as you start the businesses. You're gonna have more money to invest, and the more money you invest, the more money you could potentially earn. And ultimately, we want to be doing this while we sleeping, while we traveling, while we living our best life. And so that's why I call it my lazy girl approach. If you're interested, link in the description to join Investor Live, y'all. It's Saturday, January 31st. I'm so excited about it. I'm so passionate about teaching women how to take control of their money and grow it so that they can live their best lives and confidently be able to afford it. So thank you so much for watching. I will see you on the next video. Comment below any questions, any ideas of videos you want me to do. And the more I see it, the more I will prioritize it. So I'll see you guys on the next video. Thanks for watching.